The Iraqi Dinar Today latest news. For decades, the financial landscape of the Middle East has been scrutinized by global observers, with the Iraqi dinar remaining a central point of attention. The currency's trajectory has been closely tied to the nation's post-conflict reconstruction and its aspiration to fully integrate with the international economic structure. Tonight, we delve into reports that suggest this long period of financial anticipation has been decisively concluded, marked by an official and legally binding declaration from the heart of the Iraqi government. This is a story of a major monetary shift moving beyond the realm of speculation and into the tangible reality of state-backed economic policy. The definitive confirmation of this economic turning point reportedly stems from the pages of the Iraqi Gazette, known officially as al-Waqā'i al-Iraqīya. This publication serves as the ultimate seal of legal authority within the Iraqi governmental system, meaning any directive printed within its pages immediately acquires the full force of law. The significance cannot be overstated. This is not a leaked document or an unofficial announcement, but the highest level governmental stamp confirming a profound change in the nation's financial status. This procedural formality is the crucial step that transforms a policy debate into an enforced regulation. The core of this significant development lies in the reported details of Decree 74, as contained within the official Gazette. This decree is understood to be the formal codification of the Iraqi dinar's revaluation, a measure that has been a cornerstone of the nation's economic white paper for a considerable time. Under Iraqi legal statute, the full enforceability of any new rule or regulation is contingent upon its printing in the Gazette. This act of publication is the mechanism that officially initiates the operational phase of the new monetary policy, transitioning the state's efforts from a theoretical planning stage to actual, binding implementation. This transition has enormous implications, shifting the new exchange rate structure from an internal goal of the Central Bank of Iraq (CBI) and the Council of Ministers into a concrete, mandatory reality for all financial entities. Commercial banks within Iraq and global financial institutions conducting business with the country are now legally compelled to recognize and operate under this new framework. This mandatory adherence signals that the period of internal planning and preparation is over, and the Iraqi government is now actively enforcing a reformed monetary posture on the world stage, backed by its full legislative power. Reports detailing the specific figures within the Gazette suggest a major alteration to the currency's valuation. The decree is believed to outline a new operational exchange band for the Iraqi dinar, reportedly setting it within the range of $1.00 to $1.95 Iraqi dinars IQD per single US dollar. For context, this new reported rate structure would represent a radical departure from the previously enforced pegged rate of 1,310 IQD per US dollar. A rate maintained for many years to ensure stability during the fragile rebuilding phase of the country. The change, if implemented as described, signifies an unparalleled appreciation in the currency's nominal value. To grasp the magnitude of this alleged shift, consider a common 25,000 dinar note, which, at the former pegged rate, possessed a purchasing power of approximately $/$20 USD. Under the newly reported exchange band, this note's value would undergo a remarkable increase. Analysts describe this move not as a sudden market event, but as a deliberate and profound correction intended to realign the dinar's international market value with the vast underpinning of the nation's sovereign wealth and its substantial natural resource base. Crucially, this comprehensive revaluation effort was reportedly not an isolated, unilateral action by Baghdad. Information circulating from sources close to the Central Bank of Iraq suggests that the entire process has been executed in close and rigorous coordination with major international financial organizations. Specifically, this includes deep consultation and alignment with the International Monetary Fund (IMF) and the World Bank, ensuring that Iraq's new valuation and monetary policy remain fully compliant with all global standards for liquidity and fiscal management. The involvement of the international oversight bodies is paramount to establishing global market trust. By securing the cooperation and technical sign-off from the IMF and the World Bank, Iraq has added a critical layer of legitimacy to the revaluation process. This reassures the global community that the change is a calculated, sustainable economic recalibration founded on tangible foreign currency and gold reserves, rather than a volatile, state-driven market distortion. Senior policy figures within the CBI have reportedly confirmed this decree is the intended result of years of sustained structural reform and balance of payments efforts. Following the publication in the Iraqi Gazette, the reaction across international financial markets was swift and immediate. Global financial monitoring platforms in major hubs, including those in London, New York, Frankfurt, and Dubai, began receiving and integrating updated exchange rate indicators. This instantaneous response is facilitated by the technical integration between the Central Bank of Iraq and global clearing houses, allowing the new values to be reflected virtually in real time across the vast global financial network, including the SWIFT system. This rapid technical integration of the new exchange parameters provides compelling evidence that the preparatory work for this transition was meticulously completed well in advance of the official public announcement. Forex traders and specialized analysts observing their screens would have witnessed the immediate algorithmic movements, confirming that the global financial infrastructure was actively responsive to Iraq's demonstration of its newly restored monetary sovereignty and its subsequent binding policy decision. One of the most consequential dimensions of this unfolding story is the documented operational preparedness of major financial institutions within the United States. Reports indicate that banking entities of the scale of Wells Fargo, J.P. Morgan Chase, and Bank of America have proactively initiated specific internal protocols designed to accommodate this new rate structure. The free flow of any currency internationally is entirely dependent on the readiness of the correspondent banking network, making this American action a vital step in the process. For years, observers have been keenly anticipating the activation of the necessary banking modules and systems to handle a revalued dinar. The current news suggests that these crucial testing cycles are now live and underway. This encompasses a complex technical process of updating digital exchange platforms to correctly recognize the Iraqi dinar's new ISO codes and its associated, significantly altered value parameters, moving these institutions from passive observers to actively transactional entities. Insiders at Chase Bank, for example, have reportedly indicated that certain Tier 1 regional branches situated in key financial centers, such as New York, Chicago, and Dallas, have been given authorization to conduct limited testing of the rate integration system. This strategic, tier-based rollout approach is a standard operational procedure for major financial updates, designed to ensure the stability and security of the systems before a full network rollout to retail branches is initiated. The selection of these high-traffic financial centers for initial testing suggests a strategic focus on effective liquidity management. It implies that these major banks are treating the new rate not as a distant, theoretical possibility, but as an imminent operational requirement that necessitates stringent and verifiable technical preparedness. This level of internal focus within the U.S. banking system serves as a powerful indicator of the impending realization of the new exchange reality. Similarly, Wells Fargo has reportedly confirmed the deployment of essential software updates across its currency redemption network. Available information suggests that the bank is now listing the Iraqi dinar, and potentially other currencies like the Vietnamese dong, under an active status with live rate visibility. In banking terminology, this live rate visibility means tellers and system administrators can see the market's fluctuating real-time rate, even if the final public transaction window has yet to formally open. This high state of back-end readiness strongly suggests that the core logistical infrastructure necessary for currency exchange has been successfully patched and finalized. This ensures that when the final governmental and regulatory clearance is secured, the front-end customer experience will be both smooth and fully compliant with the new, substantially higher valuation metrics. The readiness to handle these decimal shifts and complex calculations is a major technical hurdle overcome. Security and regulatory compliance remain paramount concerns, particularly for transactions involving a dramatically revalued currency. Internal communications, allegedly from Bank of America, have indicated a rollout of enhanced HIVE, al-Waqā'i currency exchange security protocols. These measures are specifically designed to ensure complete compliance with all requirements of the Bank Secrecy Act and robust anti-money laundering AML monitoring frameworks. Given the significant increase in monetary value reported in the Gazette, any major dinar transaction would immediately trigger the most rigorous of these AML checks. The implementation of these enhanced oversight frameworks is, paradoxically, a positive signal for legitimacy. It confirms that banks are preparing for the reality of substantial, compliant wealth transfer, establishing necessary legal guardrails rather than treating the exchange as a fringe or insignificant event. The final procedural stage for the U.S. banking sector intertwines these commercial preparations with federal oversight. Analysts widely interpret the current activities as the pre-final phase before public redemption begins. Although the CBI has authorized the rate and commercial banks have updated their systems, the typical process mandates a concluding clearance memorandum from either the Federal Reserve or the U.S. Treasury to formalize full exchange participation. This federal clearance acts as the critical regulatory gatekeeper, ensuring that the introduction of new capital does not adversely impact domestic monetary supply stability. The evident synchronization between the CBI official Gazette publication and the U.S. banking system's operational readiness strongly suggests that this ultimate federal clearance is the expected and imminent next step. It represents the final alignment of foreign policy success with domestic financial capability. Shifting the perspective to the local level within Iraq, the expected economic impact of this revaluation is nothing short of transformative for the nation's citizens. The increased purchasing power of the dinar, the first such major shift since the early 2000s, directly confronts the inflationary pressures that have significantly strained Iraqi households for years. The government's stated aim is to profoundly strengthen citizen confidence in the national currency. By substantially increasing the dinar's value against the dollar, the cost of imported essential goods, everything from food products to electronics, should, in theory, decline dramatically, resulting in an immediate improvement in the national standard of living. This change is designed to induce a deep psychological shift, moving away from a traditional reliance on holding the U.S. dollar for security toward a renewed and lasting trust in the nation's own sovereign currency. Furthermore, this new monetary policy is strategically designed to function as a powerful catalyst for Iraq's burgeoning private sector. With a demonstrably stronger currency, Iraqi businesses can procure essential foreign machinery, raw materials, and advanced technology at a significantly lower effective cost than previously possible. This reduction in operational overhead enables critical reinvestment into key diversified sectors like agriculture, manufacturing, and services. This stabilization of core consumer prices is also projected to eliminate the demand for the informal, unofficial exchange channels, effectively neutralizing the long-standing black market that has plagued the Iraqi economy. As the newly sanctioned official rate becomes the most stable and attractive valuation, the underground economy loses its leverage, which then channels more capital back into the formal, transparent banking sector. Foreign direct investment, FDI, represents another significant pillar of this comprehensive reform strategy. A more predictable, highly valued currency, coupled with enhanced transparency, is expected to make Iraq an exceptionally attractive proposition for international investors. Eliminating the former complex rate currency system removes a substantial risk factor for global corporations considering commercial ventures in Baghdad. Initial data is reportedly already signaling a major surge in investment interest from sophisticated regional funds, particularly those based in economic powerhouses like Saudi Arabia and the United Arab Emirates. These funds are believed to be keenly assessing opportunities across critical sectors, including energy infrastructure, logistics, and telecommunications, viewing the stable, high-value dinar as a hallmark of Iraq's newfound economic control. The global narrative of currency reform is not restricted solely to Iraq. The success appears to be generating a measurable ripple effect across other emerging markets. The Vietnamese dong is frequently cited alongside the Iraqi dinar, given Vietnam's parallel efforts toward emerging market reform and its own foundation, building for a more flexible exchange system. Vietnam is reportedly expected to accelerate its own currency reform timelines following Iraq's apparent formalization in the Gazette. The underlying economic theory suggests that when one key emerging market successfully resets its currency to reflect its true underlying value, it establishes a powerful precedent and exerts pressure on other resource-rich nations to follow suit to maintain their global competitiveness, particularly in the export market. This emerging synchronization suggests a wider, coordinated realignment of financial systems across both the Middle East and Asia. A complementary yet distinct situation in Zimbabwe also offers a unique perspective on this global shift. Zimbabwe has been diligently pursuing a monetary strategy aimed at anchoring its national currency to its substantial reserves of tangible assets, specifically gold and lithium. This move toward an asset-backed currency is intended to insulate the economy from the hyper-inflationary shocks that have been a debilitating historical reality for the region. Economists are beginning to identify this simultaneous movement across Iraq, Vietnam, and Zimbabwe as a currency reform corridor. This conceptual corridor suggests a developing, informal consensus among major, resource-rich nations to restore global confidence in their sovereign currencies. The strategy is built on tethering value to tangible national assets, be it oil, industrial capacity, or precious metals, rather than relying solely on foreign debt instruments or external currency pegs. Expert commentary on these unprecedented developments has been extensive, offering a robust theoretical framework for this financial event. International economics professor Marcus Ellington has observed that revaluations which are genuinely backed by verifiable national reserves often trigger a wider regional and global contagion of confidence. His analysis positions Iraq's bold policy move as a critical opening chapter in a potential global monetary reset. Ellington emphasizes that sustainable value is fundamentally driven by credibility, not merely by market speculation. The publication of the decree in the official Gazette is viewed by this school of thought as the ultimate and final signal that this necessary credibility has been decisively established. By achieving this restructuring, Iraq provides a compelling model for other developing nations seeking to revalue their currencies through rigorous, disciplined monetary policy. Angela Ruiz, a senior economist specializing in emerging markets, adds a crucial layer of insight by noting that revaluation was macroeconomically inevitable once Iraq's oil-backed reserves surpassed key financial thresholds. She views the event as a textbook case of major macroeconomic reform successfully achieving international approval. Her argument is that this is a state-driven recalibration supported by tangible national wealth, distinguishing it entirely from a speculative bubble. Ruiz's analysis is vital as it reinforces the stability of the new rate, suggesting it is not sustained by market hype but by the sheer, quantifiable volume of Iraq's natural resources and the resulting liquidity now available to the central bank. Her perspective strongly suggests that the IMF and World Bank's endorsement was secured precisely because the raw economic data and asset base unequivocally support the new, higher valuation. Charles H. Monroe, a consultant with extensive experience in post-conflict economies, contributes by asserting that Iraq's success offers proof that national parity can be achieved when structural governance issues, particularly corruption, are definitively addressed. He points to the rigorous transparency and anti-money laundering reforms implemented within the Central Bank of Iraq as the necessary blueprint for other emerging economies seeking to unlock their true international value. Monroe's interpretation highlights that the path to the Gazette publication was paved with difficult regulatory decisions and an unwavering commitment to cleaning up the nation's financial sector. This perspective provides an invaluable lesson for all nations currently holding undervalued currencies. Internal governance, security, and integrity are the non-negotiable prerequisites for achieving and sustaining higher international economic value. For those who have followed this story from a currency holding perspective, the transition from an atmosphere of pure speculation to an operational reality necessitates an immediate shift in focus towards administrative preparedness. Financial experts are universally emphasizing that this is a critical time for meticulous organization rather than impulsive or rash action. The primary advice being circulated centers on securing and verifying all relevant financial documentation. This vital administrative step includes ensuring that all currency purchase receipts, precise transaction logs, and personal identification records are valid and fully up to date. When presenting currency for exchange at a regulated institution, a complete, verifiable paper trail is paramount to satisfy the rigorous compliance and security checks that the major U.S. banks have already prepared for. Being organized is the single best way to ensure a smooth, professional process under the new, strict protocols. Beyond simple documentation, understanding the forthcoming fiscal landscape is essential. Responsible financial management strongly recommends immediate consultation with qualified tax professionals to navigate the potential capital gains implications that a significant currency exchange may trigger. Sudden events of high liquidity can have major fiscal consequences under both national and state regulations, and a clear, well-vetted tax strategy is an absolute necessity. Finally, enduring financial wisdom strongly suggests that strategic diversification is key to long-term wealth protection. Analysts advise that any proceeds realized from such an exchange event should ultimately be spread across a variety of robust asset classes, which can include carefully selected equities, secure real estate, or stable commodities. This dispersed approach is designed to protect wealth and guarantee long-term financial health far beyond the moment of the initial exchange itself. The global media's reaction to the official Gazette publication has been characterized by a blend of surprise and a growing recognition of Iraq's resilience and commitment to reform. Major news outlets are reportedly shifting their coverage to acknowledge Iraq's ascent from a fractured financial system to a model of structured, state-driven reform. The prevailing international narrative is moving away from one of instability and toward one of profound economic resurgence and opportunity. Looking ahead, the trajectory for Iraq's domestic economy appears strikingly positive. Forecasts suggest that within the next year to 18 months, the nation's gross domestic product GDP could expand significantly, powered by the dual engines of profound monetary stability and the productive reinvestment of its substantial oil revenues. The newly strengthened dinar is expected to facilitate the ambitious modernization of crucial infrastructure, including power grids, ports, and transportation corridors. International consortiums are reportedly positioning themselves now to participate in these large-scale public-private ventures. This anticipated activity fundamentally transforms Iraq from a mere oil exporter into a potential, strategic regional hub for logistics and trade, utilizing its pivotal geographic position to connect Eastern and Western markets. The newly established, reliable, and high-value Currency serves as the essential new medium of global exchange. Ultimately, this monumental story transcends the simple reporting of numbers on a screen or a new exchange rate at a bank. It is fundamentally about the restoration of national dignity and economic sovereignty. For the Iraqi people, the dinar has historically been a painful symbol of national struggle and hardship. Now it stands as a clear, irrefutable symbol of national recovery, validating the years of endurance and the challenging structural reforms the population has undergone. This revaluation signals a return to a respected normalcy, where the national currency commands global respect and domestic trust. This profound psychological victory for the Iraqi populace is arguably as valuable as the economic one, fostering a deep-seated sense of national pride and a striking new optimism for the future of the nation. As we conclude, it is clear that the Gazette's publication marks the end of a long chapter and the decisive beginning of a new one, ushering in a phase of realization and execution